Welcome to the deep dive. If you're watching the market charts right now, well, you're seeing something defined by contradiction, really. Deep equilibrium in the price action, but underneath. Persistent, high-stakes tension.
That tension is exactly what we need to dig into today. It's our mission for this deep dive. We have to look past those, intraday wicks and really dissect the divergence that's happening.
Divergence, how so?
Well, on one side, you've got this short-term caution that's driven by the technicals, by some institutional hesitation we're seeing. But on the other side, foundational long-term steps, big moves towards integrating digital assets right into the core financial system.
Okay.
So the market's kind of caught deciding whether to, fear the geopolitical headlines or actually embrace the structural adoption that's clearly underway.
It's a complex picture, for sure. Our sources today seem to break this down into, four critical themes? These seem to be clashing a bit.
Yeah, that's right. We're seeing market stabilization, but then a real challenge to the institutional narrative we've gotten used to. Add in the ongoing macroeconomic conflict, and then countering that, this powerful wave of regulatory formalization.
Okay, lots to unpack. Let's start right there on the technical battleground. The chart shows volatility has really squeezed out, hasn't it? But that doesn't mean the risk is just gone.
Yeah.
What's the price action over, say, the last 24 hours telling us about the short-term mood?
Yeah, it's telling us that sellers are definitely still testing the buyer's resolve, and they found a momentary win, actually.
Wow.
Bitcoin had this brief but, pretty significant intraday sell-off. It actually breached the psychologically key $110,000 support level for a bit.
It went below 110K.
Briefly, yes. No, it managed a partial recovery, stabilized around $112,493. But the fact that $110,000 failed to hold, even for just a few hours, that validates the pessimistic sentiment that's still lingering out there.
So does that suggest institutional money is maybe playing defense right now? Like trying to hold a line, but maybe not ready to push higher, given all the uncertainty from last week?
I think that's exactly right. The recovery felt defensive. It was more about protecting the downside, not establishing some new confident upward trend. The market's been squeezed into this really narrow no man's land. It's completely reset the technical battleground.
Okay, define that new battleground for us then. Where's the real fight going to happen now?
Right now, we're stuck in this narrow range of indecision. The critical defense line, the support zone, that's between $110,000 and $112,000.
Okay.
If we see a sustained break below $110,000, that's a pretty clear signal we might retest that crash low support zone down near $107,000.
And on the upside?
Overhead resistance is looking pretty firm near $116,000. That level seems packed with sell orders right now. So a decisive move above $116,000 would be the market signaling, okay, the post-crash selling pressure, it's been absorbed.
That tight compression, especially with all the global uncertainty swirling around, it feels like we're building up for a sharp move one way or the other, doesn't it?
Absolutely.
It makes total sense then that the consensus advice right now is, be cautious, use low leverage.
Yeah.
This kind of stalemate feels designed to shake out anyone who's impatient.
Okay, but here's where it gets really interesting, maybe even a bit surprising. The institutional money flow data, the headline number suggested confidence was, maybe back. Total U.S. spot crypto ETFs recorded a net inflow of $340 million overall.
Yeah.
And Bitcoin ETFs specifically saw over $102 million in positive flows. Sounds pretty good.
Well, that headline, it's actually highly misleading when you dig in a bit.
How so?
We need to look at the structural health of that institutional bid. And the real anomaly, the thing that stands out, is the BlackRock iShares Bitcoin Trust. IBIT.
BlackRock? What happened there?
IBIT, the standard bearer for institutional adoption.
Yeah.
It recorded a net outflow of $30.8 million. Wait, an outflow from IBIT? If BlackRock, the sort of ultimate strategic buyer, is seeing outflows, doesn't that kind of challenge the whole consistent institutional bid idea we've been leaning on for months?
It certainly does, yeah. This was IBIT's first net outflow in 10 trading days. Now, okay, the volume is small compared to their total assets, but the direction, that's a huge signal.
Right.
It forces the entire market to rethink that assumption, that there's this persistent guaranteed bid just sitting there supporting the market. It injects new uncertainty into that institutional structure.
But was it just BlackRock? Or was it across the board?
Well, that's the other interesting part. The narrative isn't uniform. While BlackRock stepped back, Fidelity's FBTC actually stepped in. They led the recovery, attracting $132.67 million.
Wow, okay.
That's a loud buy the dip signal, right? But it's coming from a different institutional base. It shows divergence in risk appetite, even among the really big players.
Interesting. And while all this Bitcoin divergence was happening, what about Ethereum? I saw the Ether ETFs actually had a pretty strong day.
They did, yeah. Saw about $236.22 million in total net inflows, mostly led by ETH. It kind of suggests maybe some strategic allocation shifting away from the Bitcoin uncertainty, perhaps into the broader digital asset basket for now.
So institutional investors are clearly dealing with more than just ETF flows. Let's pull back to the bigger picture, those cross currents. The Fed versus these escalating trade tensions. What exactly was Fed Chair Powell's message that seemed to create this policy dilemma?
Powell gave what felt like a classic push-pull signal.
Yeah.
Very nuanced. On the dovish side, he acknowledged, yeah, there are rising downside risks to the U.S. labor market. That usually hints at, future rate cuts.
Right, the usual playbook.
But at the same time, he introduced a major constraint. He cautioned that the whole tariff situation, the ongoing global trade conflict, could actually become a persistent source of inflationary pressure.
Okay, wait, so you're saying global trade conflict now has like a double negative impact on Bitcoin?
Precisely. It used to be that negative geopolitical news just triggered a general risk-off feeling, right? Sell risky assets. But now, if that conflict also generates inflation through tariffs, it directly restricts the Fed's ability to respond dovishly to cut rates like they might want to. It ties their hands. So Bitcoin becomes highly sensitive to these geopolitical headlines. It's a dynamic we've seen picking up speed.
Let's get specific then on the U.S.-China conflict escalation. It sounds like it's moving beyond just broad tariffs now, into more targeted areas.
Yeah, we've seen two new fronts open up pretty quickly. On the agricultural side, there's retaliation brewing. President Trump is apparently considering, and I quote, terminating business with China having to do with cooking oil.
Cooking oil.
Yeah, it sounds specific, but it's seen as a direct response to Beijing refusing to buy U.S. soybeans. It's about instilling quick economic pain.
Okay, and the other front.
That's technology. China launched an anti-monopoly probe into the U.S. semiconductor firm Qualcomm, specifically over its acquisition of Autotalks. This feels like tactical political warfare, targeting crucial bits of the tech supply chain. It directly injects uncertainty into those innovation sectors that Bitcoin often tracks. Geopolitics has become a massive headwind for the market right now.
It really is astonishing how quickly that geopolitical risk now translates into market constraints for crypto.
Yeah.
So if the short-term news has us kind of stuck in neutral, where's the serious long-term building actually happening?
That shifts us to regulation, right? The counter-narrative where foundations are being laid.
Exactly. And this is where the genuinely good news is happening. We're seeing these regulated bridges being built, connecting directly into the traditional financial system.
Like what?
Well, for instance, Stripe's stablecoin subsidiary Bridge. They've applied for a national bank trust charter with the OCC, the Office of the Comptroller of the Currency.
Okay, the OCC, that's federal oversight.
Right. Federal supervision of that kind would let them offer fully regulated digital asset custody and also stablecoin issuance. That's a big deal for legitimacy. That's definitely a major step for TradFi integration. But the Telcoin news you mentioned earlier, that sounds almost more disruptive, fundamentally.
I think it is, yeah. The conditional approval of the Telcoin Digital Asset Bank in Nebraska, that's a potential game changer.
Right.
Because it's set to become the first U.S. banking charter that's specifically authorized to connect its bank customers directly to decentralized finance, DeFi protocols, and all under a federally regulated framework.
Wow.
This is a massive leap. It goes way beyond just holding stablecoins. It's creating a regulated pathway for first retail, but eventually institutional clients to access things like decentralized yield and lending protocols.
That kind of structural progress seems to be mirrored elsewhere, too, in major economies. Can you detail those key steps towards market integrity and clarity?
Sure. First, back in the U.S., California's DFAL, the Digital Financial Assets Law, its comment period just ended. That basically clears the path for a comprehensive digital asset licensing system to be implemented by July 1st, 2026.
Which removes a lot of legal gray area in a huge economy.
Well, exactly. Massive vote of confidence. Second, look at Japan. The Financial Services Agency, the FSA, they're actively working on changes to financial laws to explicitly prohibit crypto insider trading.
Okay.
This is a G7 economy creating clear investigation authority, setting a precedent for market integrity. That's absolutely essential if you want to attract serious institutional capital that's been, frankly, put off by worries about market manipulation.
And that focus on integrity seems totally warranted, doesn't it? Especially when you hear the ongoing buzz around that alleged huge profit, what was it $88 million to $200 million, potentially made from shorting right before that recent tariff news hit.
Precisely.
Market integrity is really moving from just a nice-to-have to a core regulatory pillar everywhere, it seems. Okay, let's wrap up by looking past the day-to-day volatility. What about the hard growth numbers that confirm the long-term direction this technology is heading?
Right, the tokenization thesis, specifically looking at real-world assets or RWA, it's not theoretical anymore. The RWA market has now crossed $30 billion here in 2025.
30 billion, wow.
Yeah, that's a threefold increase just since 2023, and it's primarily driven by tokenized U.S. Treasury bills. This isn't just, incremental growth. This is the actual construction of a new financial system happening in real time using blockchain efficiency for traditional assets.
And what about tangible economic impact,
Yeah.
especially in emerging markets, which often seem to lead the way in adoption?
There was a really compelling study from the University of Indonesia. It provided hard data estimating that their domestic digital asset sector could contribute something like $16.5 billion to the nation's GDP.
Billion, with a B.
Billion, and potentially create 1.22 million new jobs. This is huge because it starts to shift the global policy conversation, viewing digital assets less as just a speculative risk and more as a potential engine for economic growth and job creation.
We should probably touch briefly on the stablecoin battleground, too. It's massive now, right? Over $300 billion market cap. The competition there seems to be really segmenting.
Oh, absolutely. You can see three main camps emerging, all vying for dominance. You've got the crypto natives like Circle, who still command most of the liquidity within DeFi.
Okay.
Then you have the fintechs, think Stripe, PayPal. They're integrating stablecoins into their massive existing user networks, focusing on payments.
Right, making it easy to use.
Exactly. And finally, you have traditional finance, the big banks. They're focusing more on a wholesale interbank settlement, usually within regulated permission systems. They all want a piece of controlling those digital dollar rails.
Got it.
And one last point, we have to revisit that divergence within the crypto asset class itself. While Bitcoin kind of held its ground today, the broader altcoin market showed definite weakness. Tokens like BNB, XRP, ADA, DOGE, they saw declines over 3%. That tells us that capital, when it's faced with this geopolitical uncertainty and maybe some institutional hesitation, it does what it often does. It executes a classic flight to quality, consolidating back into Bitcoin as perhaps the perceived safest bet within the asset class right now. Hashtag outro. So the final analysis really is that as an investor, you are navigating some extreme short-term uncertainty that's being dictated by these geopolitical factors. And we saw evidence in that technical $110,000 failure and, importantly, the IBIT outflow anomaly. Keep a close eye on the next few days of ETF flows. That might give us a verdict on whether that BlackRock outflow was just a blip or something more significant.
So what does this all mean then? Well, it seems the long-term adoption thesis isn't just intact, it's actually being structurally validated by serious regulatory progress in major economies like the US and Japan. This divergence suggests that the macro-induced volatility, the choppiness we're seeing, it's likely going to keep presenting potentially unique accumulation opportunities, but probably for investors who can maintain that multi-year horizon and, separate the market noise from the actual foundational construction happening underneath.
That's well put.
And think about this. We heard about the Telcoin Digital Asset Bank, the first regulated entity potentially authorized to connect regular bank customers directly to DeFi protocols. That really raises a fascinating question for you to consider. What actually happens when fully compliant, federally overseen institutional capital finally has a secure, regulated bridge into the world of decentralized lending, borrowing, and yield generation? The foundations are clearly being built right now, but the financial implications of that bridge, when it's fully operational, they could be staggering.